Okay, what's going on, everyone? This is going to be the first video for chapter 6, right? So we're going to be looking at individual deductions here, right? So we're talking about tax deductions. As an overview for the chapter, right, just very kind of high level here, we're going to look at above the line deductions related to business activities, above the line deductions that are indirectly related to business activities, above the line deductions subsidizing specific activities. Then we'll move to below the line deductions, looking at itemized deductions, the standard deduction, the QBI deduction, and the big, beautiful bill deduction. So really, right, it's all about deductions. And remember, you have the above the line deductions, right? So you start with your gross income, you take your above the line deductions. If you qualify for any of these, like A, B, C, D, E, you can take them. That gets you to your AGI. Thereafter, from your AGI, you subtract out the below the line deductions. So that's kind of what we're looking at here, right? We'll start with above the line deductions, then we'll land at our AGI, and we'll look at our below the line deductions. When we talk about the 1040, right, do be aware that it's, appears simple when you first look at it, like 2 pages, like, yeah, there's a lot of inputs on there. There are a lot of forms that flow into the 1040, and it's kind of like if you've ever done an accounting internship or if you looked at a big complex Excel book and there's kind of like a front tab and all the tabs that build into it. Similar thing with the 1040, right? So we'll have like a Schedule 1, a Schedule 2, a Schedule 3. We'll talk about these kind of other schedules, so C, E, F. So all of these flow in and they kind of manifest that formula of the income, deductions, credits, and then these kind of other activities. When we talk about deductions, right, we said the line is AGI, right? So you start with your gross income, right? So kind of all your income. You make some adjustments to that, namely above the line deductions, and that gets you to your adjusted gross income. So it's this gross income adjusted for these adjustments. We will see, right, with regard to above the line deductions, there's kind of 3 categories you can put them in: business, indirect business, and then a lot of them tend to more recently be subsidizing specific activities. If we want to accomplish this certain goal in society, we'll give you an above the line deduction to encourage that activity. Once we land at our AGI, right, then we start to look at our below the line deductions. The first thing is that kind of fork in the road. Are you going to itemize or take the standard deduction? We'll talk about those itemized deductions. We'll have a little acronym, kind of a commit acronym or COMIT acronym to help you remember what those are. The standard deduction is generally going to be a flat amount. It's a little bit wonky if you're older, right? They'll give you some additional standard deduction. And then if you're younger and you're claimed as a dependent by somebody else, it also gets a little bit wonky. There's also, in addition to this fork in the road, right? So you also get these guys if you qualify for the QBI deduction, which is generally a 20% deduction for flow-through income on there. If you're a partner in a partnership, a shareholder in an S corp, or you're a Schedule C self-employed taxpayer, when that income flows through to you, assuming you meet a bunch of criteria, you will get a deduction for 20% of that income. More recently, right, there's these big, beautiful Bill Act deductions, so things for like tip income, overtime income, qualified car loan interest income, and then a senior deduction. So we'll look at these, right? The first lecture, we're going to focus on just the above the line deductions. So with that, right, when we look at those kind of above the line, right, we have those related to business activities. These are going to be those traditional forms, right? So for example, a Schedule C, that's if you're self-employed, you have like kind of a sole proprietorship, you run a business on there. And essentially we'll talk about it, right? You put your income, hey, maybe I paint houses, I made $10,000. You put your expenses, maybe I had $3,000 of expenses. So 10 minus 3 equals 7, right? these expenses on the Schedule C, they are technically an above the line deduction because how it ultimately rolls up and flows through to on your 1040, they happen before you establish AGI, right? So we'll look at a lot of these, and it's a similar thing for D, E, and F. They're not traditional above the line deductions in the sense that they're not what I think of immediately for an above the line deduction, but technically they do happen. Before you establish AGI. These other ones are more what I think of traditionally with above the line deductions. Indirectly related to business activity. So maybe you file that Schedule C, right? You have to pay health insurance. We'll talk about you get a deduction for 100% of health insurance, half or 50% of self-employment tax. Other items here, moving expenses, only if you're active duty military, early withdrawal penalty on a CD. And then we have these kind of like other ones where we're trying to accomplish certain societal goals. We want people to do certain things and we'll reward them. So for example, saving for retirement. If you contribute to a traditional IRA and you meet certain income criteria, you can get an above the line deduction. Similarly for HSA contributions, a health savings account, if you have a high deductible health plan. Educator expenses, if you're a K through 12 educator and you have like unreimbursed out-of-pocket expenses, you can get a deduction above the line. Kind of old school alimony, right? If you're grandfathered into that older alimony and you're paying it, you can get an above the line deduction. And then student loan interest potentially gives an above the line deduction. We'll look at each of these, but starting with those kind of above the line deductions related to business activities, at a starting point, we really have to distinguish a business from a hobby or a personal activity because the tax code will give you deductions, right, for ordinary and necessary business activities, but very limited and no deductions for things like personal activities or hobbies, right? So by way of example, right, say that you paint houses, you do roofs, right? Those kind of ordinary and necessary expenses that you incur, you'll be able to get a tax deduction for those. Compare that with, right, maybe I glue popsicle sticks together and periodically I sell them, for a little bit of money and, overall I'm at a loss, right? That would be a hobby. They're not going to let you take a deduction for a hobby because if you think about it, then you could start to mess with like your income because you could fictitiously make these hobbies and potentially offset certain types of income on there. Likewise, personal activities. We will see things like your personal everyday credit card. If you pay interest on that, you're not going to get a deduction. But if you compare that with something like interest on a business credit card, then you would get a deduction for that. Likewise, personal activities, there's no kind of boyfriend or girlfriend deduction. There's no pet deduction, right? These are kind of personal things, non-deductible. When we're talking about like a business versus a hobby, one kind of traditional test, and there's various factors that go into this, is they really look at the last 5 years and they say, hey, were you at a loss for 3 of those 5 years? If so, this is a hobby. It's not a business, and we're going to limit your deductions on there. This comes into play a little bit in practice, if you do like, for example, the Vita Clinic or you have friends, artists, musicians, right? A lot of times they're not necessarily profitable, right? It's like a tough kind of lifestyle to do that. When you tell an artist, for example, that, hey, you don't get a deduction for your art supplies because this is more like a hobby, that can be offensive to them in the sense that it's their life and their livelihood. So in those kind of situations, that's part of developing soft skills. You might want to say something like, hey, look, I don't make the test. I'm not kind of denigrating your profession. I'm just telling you this is how the IRS views it, and we need to make sure that we kind of treat it appropriately. Okay? One thing to be aware of, there is definitely a difference between being self-employed and an employee. Right? An employee is what you traditionally think of like, hey, I do my internship, I get my full-time job. You are working for an employer, right? So if you go and you do an audit internship with EY, you are an employee of EY. generally you're not going to get any deductions related to your work, right? Like when you commute, that's a personal, non-deductible expense. If you have to buy work outfits, like a suit and a tie for your accounting job, you're not going to get deductions for that. However, right, if you are self-employed, right, where essentially you run your own business, traditionally kind of a one-man show, then you would be eligible for business deductions, right? So kind of mileage when I'm driving to the clients to do the roofs, to paint the houses, uniforms, right? Assuming it's like a work uniform and it's not kind of usable in a way in everyday use, right? Maybe it's like a special kind of outfit that I can only use on the job. You might be able to deduct that. Your internet, to the extent you use it for your self-employment. Your cell phone, to the extent you use it in your self-employed trade or business. You would be able to get deductions for that, but generally not if you're an employee. So one kind of way to distinguish this, where's my mouse at here? Here it is. I try to think of the Seinfeld reference where George works for the Yankees, right? He's a W-2 employee, right? The employer is the Yankees and he is the employee, versus when he is a hand model, right? He is self-employed. He's kind of working for himself. He's getting these kind of gigs doing hand modeling jobs. So he might be able to get deductions for things like lotions and creams because they would be kind of ordinary and necessary to that business, right? He has to keep his hands looking good. But traditionally, right, an employee is what you would think of, like an accountant, a teacher, a nurse, any of these kind of jobs where you work for somebody else. Whereas self-employed tends to be more like freelance or kind of sole proprietor, right? So gig workers, if you drive Uber, if you do Uber Eats, you would be self-employed. Photographer, right? Maybe somebody just hires you just for their wedding, right? It's not a continued relationship. A freelance writer, right? Like you write an article one-off for a certain company. Tutoring, babysitting, dog walker. This is not an all-inclusive list. And it doesn't mean that it's always this case, right? So for example, you could be an employee as an accountant, but if you had your own kind of one-man shop, you'd be self-employed. So it's not categorical that this is always the setup, but these are traditional professions that you would see. With that, right, if you are self-employed, you can get and take a business expense, and it has to be ordinary and necessary, right? What we would traditionally think of in operating this business. Typically, you would file a Schedule C. So for example, you're an Uber driver or something, you would put all your income from Uber. Remember, they pay you out kind of the gross total amount. They don't do with any withholding on there, and then you would take all your expenses. One potential thing you could get, right, and this might be not necessarily Uber, but say you're an accountant and you're self-employed and you have a home office, right, and you use it exclusively for that, right? You can't have like a bed in there and sleeping or anything. You might be able to get a home office deduction. You do not get this traditionally if you're self-employed, right? So if you're an accountant and you're an employee and you're like, hey, I work from home 3 days a week, can I expense my internet? Can I expense my home office? No, you're a W-2 employee. Even if you are self-employed, the home office expense, that is a big kind of, it's not you can't get it, right? But it's an often audited item. So if you're going to take that and you're self-employed, you really need to do your due diligence. But for example, Schedule C, hey, profit or loss from a business. Think a one-man show business. It could be a painter, a roofer, or it could be your kind of a gig worker, right? You put your income, you put your deductions, right? That gets you your net profit or loss. So maybe 100 minus 20, right? Then we're at 80, right? That's our net profit or loss. That amount, right, it ultimately goes to the Schedule 1, which ultimately goes to the 1040. And again, these expenses, they technically happen before we establish AGI. That kind of net profit or loss, that goes over to the Schedule SE, right? So 80 would go over here, and then we would start to calculate self-employment tax on that. So just kind of planting a seed when we talk about SE tax. Similarly, right, rental or royalty income, right? If you're a landlord, for example, and you rent out a property, you would file a Schedule E on there, and it would essentially be a similar thing, an income, your expenses related to the rental. Those expenses would happen before you establish AGI. One thing you have to be aware of, for example, is you always have to look at the facts and circumstances. So for example, if it's a rental property tax, right? Like I rent out an apartment, I have to pay property tax. That would be a deduction on Schedule E. Compare that with property taxes on your primary residence, right? That's not a business activity. That would go on your Schedule A as an itemized deduction. So it doesn't mean all property taxes go on Schedule E. You have to look at the kind of the nature of the item on there. So there's a Schedule E, very simple, like your income, your expenses, right? There's kind of your net amount. We also have Schedule D, right, which is going to look at your kind of capital gains and losses. One thing to be aware of is if you're at a net capital loss, right? So, at one point in time in my life, I had this kind of genius idea. I would buy WWE stock like a month before WrestleMania, and like surely it would go up, right? Because WrestleMania, well, I ended up losing like $5,000, right? So if I ended up losing, let's just say $5,000 on the WWE stock, and I don't know, let's just say another stock I was positive, right, for 1,000. Again, this is what I made or lost on it. It's not what I sold it for. Remember, amount realized minus adjusted basis, right? Overall, I would be at a net capital loss of 4,000. I could use 3,000 of that to offset ordinary income. The remaining 1,000 I would carry forward to the future, but technically that would be an above the line deduction. Income, expenses, losses, and other items from flow-through entities, right, such as partnerships, LLCs, S-corps, those are going to pass through and be reported on the Schedule E, right? So if you get a K1, you're a partner in a partnership, that will flow through. You'll report that on Schedule E. You can read the excess business loss limitations. Not worried about this for an exam, but it basically just says something along the lines of, look, we're going to put a cap on the amount of losses from, for example, flow-through entities that you can use on your tax return. Okay, so now we're going to move to indirect business activities. We talked about those kind of traditional forms, right? Now let's talk about some other kind of items. Moving expenses, right? This is only if you're active duty military. In other words, if you're an active duty military, hey, I got to move from Pennsylvania to California, I spend money out of pocket on there, I could potentially get an above the line deduction. Compare that with, hey, I got a job offer at an accounting firm 3 states away, and I got to rent my own pod storage system to move all my stuff, no deduction for that. So traditional W-2 employee, no deduction. But active duty military, yes, on there. So that's kind of the setup there. Traditional W-2, no deduction. How about if your employer pays for your moving expenses, right? I get a job offer. Hey, we will give you $5,000 to relocate for your moving. That's taxable income in that case. So do be aware of that kind of setup. Your first paycheck would show that $5,000 of income, and you got to pay tax on that. Continuing with this kind of indirect business activity, right? So how about health insurance for the self-employed, right? So we're talking about George. He is self-employed. He's the hand model, right? One thing we have to kind of look at, we try to do and balance in the tax code is like if there's a certain setup for employees and employers, we want to try to mirror that with self-employed taxpayers. So if we look at this, right, maybe it's a little bit easier to show it over here. Let's say George works for the Yankees. He is an employee, okay? Let's say the Yankees, right, whenever you have an employer, they will pay every month part of or potentially all of your health insurance premiums, right? Because the premium is what you pay every month, right? The M in the premium, monthly you pay the premium. Very common that your employer pays part of that and you pay part of that. When the employer, right, the Yankees are like, George, we hire you, we're going to pay for your monthly health insurance premiums. They, on their 1120, assuming it was a C Corp, right, they would get a deduction for that, okay? So it's like our employees. In the same way like we pay your salary, they would get a deduction. It would be an ordinary and necessary business expense. Compare that with George's self-employed, right? So for example, he may get a 1099 from doing a gig worker job or a modeling job. One of the things that happens is when you're self-employed, you are functionally the equivalent of both the employer and employee, right? You're not actually an employee, but you're considered both, right? Because you're kind of the business owner and you also work in that business. So what happens here is, hey, in this situation, right, the Yankees, the the employer, they got a deduction for when there was health insurance paid. Here we are self-employed, right? We're functionally also the employer. So when we ourselves, we file a Schedule C, we just run our own business, when we pay our health insurance premiums, we should also get a deduction, right? We're trying to make things equal on there. The business gets a deduction for health insurance over here, so the business gets a deduction for health insurance over here, and it's going to be for 100% of whatever those premiums are, okay? Compare that with, right, kind of remember this idea of parity, balance. George, if he's self-employed, is going to get a 50% deduction for self-employment tax, okay? Let's take a step back because this gets a little complicated. Self-employment tax, right? So if you are an employee, right? So he works for the Yankees, right? Let's just say he makes $100,000 a year, right? There will be FICA tax on there, right? So he makes 100 grand. What happens is they kind of split the baby for who's responsible of this. Hey, employer, right? You're going to pay half of it, $76.50. And employee, right? You're going to pay half of it, $76.50, right? It's a 15.3% tax FICA, but they split the baby, right? 15,300 on there. They split it between those two people, right? The employer and the employee. Compare that with, right, George is self-employed, right? George makes, let's just say $100,000 of net self-employment income, right? So maybe it was like 120 his gross, he had 20 in expenses, right? So he lands at 100 on that Schedule C. Now what happens is George, because he is both the employer and the employee, he's going to be responsible for all 15,300, right? And that's just kind of a ballpark number. The calculation of self-employment tax is a little bit more complex. Why do we care about this, right? Well, kind of thinking back to that idea of balance, whenever the Yankees over here, right, when there's FICA tax in the employer, the Yankees, right, they pay half. In the same way they got a deduction for George's health insurance, they're also going to get a deduction for that half of the self-employment tax they have to pay. Over here, right, when we have George, right, and there's the SE tax, right, self-employment tax, it's functionally the same thing, right? He's basically going to say, well, I'm the employer as well, so I should get, right, half of this, 50%, right? So 76.50, for example, in this case, if it was, 15,300, so he would get a deduction for 76.50. The employee and the kind of the remaining half over here, you don't get any deduction for. So that's kind of what this slide is saying, right? So we first talked about health insurance, it's 100%. Now for self-employment tax, it's 50%. We're trying to create kind of parity again between those kind of two things. Other items, right? Retirement contributions. So you can take an above the line deduction up to a threshold amount. It changes year over year, $6,000, $7,000, $8,000 to a traditional IRA on there, consistent with your contributions. A lot more complexities to this, but that's kind of how it works with a traditional IRA. In distinction, right, you can also make pre-tax contributions to a 401k, a 403b, or a 457 those are kind of more exclusions than they are deductions. They're just going to take those right off the top on there. HSA contributions, what does this mean? So essentially, whenever you get offered your job, right, you can take kind of more of a premium Cadillac health insurance where essentially you will have a bigger monthly premium, but you will have a smaller deductible, right? So you'll pay more each month, but like if you have some type of giant health expense, you'll have to pay less before insurance kicks in. Or you can have something called a high deductible plan, right? Where you will have a lower monthly premium, but a higher deductible. So you might have to kick out 10 grand or something before insurance starts to really kick in. If and only if you have a high deductible plan, right? So if you have this kind of premium Cadillac plan, you do not get an HSA, right? But if you have a high deductible plan, there's kind of this companion HSA account where you can get and contribute to it, where essentially you can get an above the line deduction for the contributions. I kind of think of it like a bank account almost that you can use for health expenses, but you only get this with a high deductible plan. Okay, and one good thing with it is it carries over, it's portable from employer, so if you quit your job, you can take it with you. But again, what health insurance you pick, it's kind of a facts and circumstances. Traditionally, what they say is if you're young and healthy, you should pick a high deductible plan and contribute to an HSA. When you're older, you should get that kind of more Cadillac plan. It's always everybody's life events and setup is different. Here's a W-2, for example, right? So like we'll look at this when we do the VITA stuff, but one thing I wanted to call your attention to when I first started my internship or job, I was like, wait a minute, right? Like this person made 50 grand, but why are we showing 48.5 there? Well, that's because a very common box, right, would show those kind of pre-tax contributions. So for income tax, right, federal income tax, we're going to report 48.5, but for FICA tax, right, we're going to report 50,000 on there. So it wasn't a mistake on the W-2. It's just showing, hey, for income tax purposes, we made a contributions to a pre-tax retirement account. Early withdrawal penalty of CDs, right? Once upon a time, there was something called a CD, right? Before there were like, iPhones and all that. That's what I think of with a CD, but another variation of a CD is kind of an investment account, right? So, hey, I have $100,000, right? Maybe I'm kind of, when I'm, very carefully invest my money, I'll buy a CD, and then a year later, right, they will pay me $115,000, right? I got 15 in interest. It's basically an investment at a bank, right? You go and you buy this kind of financial instrument. They lock up your money for a period of time, and then at the end, you get paid out the interest on there. One thing that happens is, right, say you are in need of this money, right? You put the 100 grand, they lock it up. If you withdraw it early, right? So say you withdraw it halfway through and they pay out to you, okay, you didn't earn 15, but let's just say you earned 110, right? And then they also said, okay, you withdrew it early, we're also going to charge you a fee of 4, right? So there's an early withdrawal penalty on there. How does this work, right? Well, if you think about it, you put 100 in and you got 110 out, right? So you're going to have 10 of interest income. What do you do with this fee, right? Well, what you have to do is report the gross income, and then you take an above the line deduction for the fee, right? That's how it works. What would be wrong is if you just netted them and you put 6 on your gross. No, it's not how you do it. They want to see it reported separately. Kind of similar there with gambling winnings and losses. They don't want you kind of hiding and massaging things in numbers. We really want you to spell it out as things happen. Educator expenses, right? If you are a K through 12 educator, right? Like Mr. Feeney, if you've ever seen Boy Meets World, kind of a 90s show there, good show. You have unreimbursed education related expenses. So, hey, I have a classroom I got to buy Kleenexes and crayons for. You can get an above the line deduction. It's like $300 at max, changes year over year. Old school alimony, right? You look at that divorce decree. Hey, I was divorced 2018 and beforehand, and I'm still paying alimony to my ex. Now I can get an above the line deduction for that. Different story if it's kind of current alimony. Final thing is student loan interest up to $2,500. So that's kind of fixed. That doesn't change year over year, but that's at the end of the rainbow, right? And essentially how this works is, right, whenever you borrow money and your student loans kick in, let's just say your monthly payment is $500, right? Some of that payment is going to be going to the principal, maybe $450, and some of that payment is going to be going towards the interest, right? So, every month you're going to pay $50 in interest on your student loans, okay? At the end of the year, right, you will get a tax document, right? So 50 times 12, let's just say every month, okay, you paid $600 of student loan interest. A 1098, your kind of loan mortgager would send you this document. You could potentially get a deduction for this, right? So $600, right, depending on your income, you could get it. But say it was like $3,000, right, then the max you could get is $2,500, right? So the max is $2,500. That's at the end of the rainbow, but there is a phase out on this. Typically, I don't test phase outs, but if I were to test this, for example, I would give you the chart and show you how to do it, right? So let's look at an example here, and then we'll kind of wrap things up because we're getting at the half-hour mark. Okay, so we have a taxpayer, right? Their MFJ, they paid $2,000 of interest expense on student loans. Their MAGI, their modified adjusted gross income, is $182. Can you please tell me, right, how much above the line deduction they get for student loan interest? Well, we know $2,500 is the max. Okay, well, it's below $2,500, that's good, but there's also a phase out based on your amount of income, your MAGI in this case. So what we would do is go to the table, right? We essentially say, okay, there we are, right? We're MFJ. Here is kind of the equation, right? MAGI minus 170 over 30, right? So here we'll kind of plug it in. Our MAGI is 182 minus 170, right? So it's 12. That's great. 12 over 30 equals 40%. That's kind of our percentage there. We paid $2,000 times 40%, right? So basically of the $2,000 we paid, 800 were phased out, which means 1,200 we get the deduction for on there. So you just need to be able to use the chart. One thing to call your attention to is it's not that high of a phase out, right? So for example, if you're single on there, once you hit 100 grand, you don't get anything of student loan interest. So it phases out rather quickly. But if this were tested, this chart would be given. With that, right, that is going to be the above the line deduction. So there's that chart. Next time when we pick it up, we're going to move to the below the line deduction. So we will see you in that video.